Hello, I'm Dominic Hobson, co-founder of Future of Finance. My guest today is Vivek Ramgopal, Vice President and Head of TCS Financial Solutions at Tata Consultancy Services, where his responsibilities include the TCS Bank Securities Processing Platform used by dozens of custodian banks and central securities depositories, and Quartz, the new set of blockchain-based services TCS has launched to support investment in cryptocurrencies and security tokens. Vivek, thanks very much for joining us.
Thank you, Dominic. My pleasure. Good to talk to you.
I thought we might start, Vivek, by talking about CSDs and custodians. Can you give us a flavor of the type of projects, and by projects I mean something other than proofs of concept and pilot schemes, that you're working on with exchanges and CSDs at the moment?
Yeah, sure, I can. We are working with about a handful of organizations, Dominic. And interestingly, 3 of those are stock exchanges, and a couple of them are CSDs. So it's quite interesting that there are more stock exchanges talking to us today, than CSDs. Quite a few of them are looking at, this is an opportunity for them to completely service the value chain end to end in a tokenized form. So that's why it's more the exchanges who are talking to us. They are talking about such projects, not talking to us, working with us, right? So we are working with these organizations. I would think that from the second half of this year, they will start going live one by one. So between now and the end of 2022, I would expect about 5 market infrastructure institutions to go live on Quartz.
Stupid question. The exchanges you're working with, do they tend to own CSDs as well? Are they seeing this as a full value chain proposition, or at the trading level only?
One of them does, the others don't. They see it as a full value proposition that they will create. And those who are doing that are not doing it for equities or fixed income. They are doing it for alternative asset classes, which they believe they will provide a trading place for the first time too, right? So it's like, so they will create a new kind of segment, and they will provide end-to-end services on that segment. So that's what they are looking to do. And at least one of them, Dominic, is very actively talking to the regulator because this is the first time for the regulator also to approve something like that. So it's an interesting scenario. But to some extent, they are looking at it like how commodities exchanges created a market without having to necessarily deal with warehouses. So that's the parallel I would take.
Right. So regulators need to be educated as well. Are you seeing, if you look across the client base that you're working with now and looking to work with in the near future, is there a greater willingness on the part of a certain type of CSD, by which I mean maybe CSDs in emerging markets, to experiment in this area? Are they more willing than, say, CSDs in developed markets, exchanges in developed markets as well?
Tough to say that. Not necessarily. I think the CSDs who are, I would put it this way: the ones who need to compete in some form are the ones who are looking at these things, right? Those who don't need to compete, who are very comfortable with where their market is and how they are a near monopoly in their market, they are not looking at it, honestly, right? Those who need to compete, they need to continuously find ways in which they are ahead of others, be it exchanges, be it CSDs. So that's the difference that I would put, rather than major markets or mature markets or emerging markets. It's more about whether they are going to compete for a particular business, whom they compete with, and the fact that they need to have an edge on it. That's how I would put it. And there are only these handful of countries, right, Dominic, globally, where you have multiple stock exchanges, multiple clearing organizations. So their need to compete is higher. That's the difference that I see.
Budgets a problem for CSDs in particular? I assume exchanges are pretty well funded, but CSDs are not always the most lavishly funded parts of the infrastructure. Is budgets a problem?
No, I wouldn't say so. Mm-hmm. Budgets are not the problem. A lot of them are waiting and watching. They want to get it right first time. A lot of them are not willing to in some sense, they have to think like a fintech. They have to think like a startup. They have to try 3, 4 things, and get those ideas mature, take it to the regulator. Not all of them, I would think, are putting their energies into it, but it's not for lack of funding.
Perhaps we could talk a little bit about the impact of this on CSDs in particular. If we end up in a world in which security tokens are being issued into digital wallets, and those digital wallets are controlled either by the investor themselves directly or by some third-party provider, such as a custodian bank, are CSDs still necessary in that environment? Are they concerned that their occupation is going to be gone if the world moves towards security tokens?
No, I don't think they're seeing it like that. Which otherwise I think they would move faster. I don't see them looking at it that way. They probably still see them as the custodian of whatever be the form of securities that will exist in the future. In a sense, they have probably a regulatory protection, and so they are comfortable with that. That any listed security in their markets will always be held by them. So they have that protection and they have that thinking. So I don't think that they are looking at a world where they would not exist. In a lot of alternate asset classes, sometimes even with insurance repositories, right? Or even with alternative, like it's a financial asset, right? Or an alternative financial asset. Even in those cases, a lot of the CSDs tend to think that that is someone else's business. That is not the core business that they have been created to service. So they just leave it to the side possibly and say, no, let someone else do it. We don't mind not doing it. I see more of that line of thought rather than one to say that, would they exist in the tokenized world? I don't see it like that.
Mm-hmm. Now, if we ask ourselves what CSDs need to do to evolve their services as security tokens take off, and we're still in the very early stages of this market developing, and lots of ideas have been put forward. They could become providers of digital wallet services. They could offer them in omnibus forms or segregated form. They could act as typical blockchain fashion as transaction validators. They could start to, this is a very lavish idea, start to orchestrate the provision of services, maybe have daily or real-time or regular auctions of all the different components of a full security services product. So they'd hire somebody to do settlement, somebody to do stock loans, somebody to do collateral management, and so on. And you could basically unbundle all the services which a global custodian bank provides today and auction them to independent providers. They could get involved in interoperability between security token networks and between those networks and the traditional markets. There's going to be a long period of transition after all. They could start expanding into whole new sectors, adjacent sectors, trade finance, insurance. They could even get into wholly new things like in your own country, you've seen CSDs getting into storing educational credentials, digital identity, and so on. So actually there's lots of opportunities here as well, aren't there, for CSDs to grow? What are you advising them to do, and what are they telling you they're thinking of doing?
Yeah, so this is like, and I think this will come to central banks also when it comes to CBDCs, right? The whole wallet question. It's not just a CSD question, it's for any central organization. The problem with this is whether the CSDs are wired as an organization to service the retail customer, the man on the street, or the person on the street, right? With technology, I think they can do that. But are they organized to handle the end customer? Most of them are not, right? Most of them are organized to handle the institutional customer, the custodian, the exchange. They are owned by them. They are also kind of in an STP world. So from that perspective, I think they are not naturally created for this, naturally oriented for this. What are they good at doing? Among the questions that you posed, Dominic, I would think they are geared to be governing this. They are geared to run this. The CSDs can run the permission networks. right? They can govern that, they can administer it, they can bring people together. I think he also spoke about whether they can be this independent player who can provide, who can bring together people who provide these services. All of those are very natural for them. In a market where you want tokenized settlement, I think the CSDs are in the best position to create the permissioned networks and run and administer, govern those networks, provide the regulatory reporting that is needed for tokenized securities. In case listed securities go that way, for example, right? They can provide wallets. You took the Indian example. There are quite a few CSDs, including in India, where they provide services to all of us who are investors, to the retail investor. But they are fairly, you could say basic services, reporting. You get a report, etc. They provide tax administration services. They provide a range of services which are outside the domain through subsidiaries, like a skill database, educational degrees which are verified, etc., etc. There's no end to that. But I think they are all not naturals at providing the wallet kind of retail service, which a custodian can do, which a bank can do, right? Because they're used to providing those services. They can provide it off the same digital interface that they have today. There is a lot of disruption even there, but that's a different conversation. But I think they are more naturally positioned to provide those services than the CSDs.
You mentioned CBDCs, and I'd like to come back to that in a minute. But before I do, could I just ask you one very specific thing? We've talked about the issuance function of CSDs, and they can retain that by being digital wallet providers. But what about the registration function, keeping a list of who owns what? Now, that's a core CSD function in most markets. I mean, there are markets where registrars still exist, including my own here in the United Kingdom, but that's a core function. But a core feature of any blockchain technology is that you have this real-time register. It's one of the things it does. It keeps track of who owns what in real time. End of record dates. The registration function becomes much easier to operate. Is that registration function of CSDs doomed, whatever happens in future?
It cannot be in today's form, right? Because registration is almost implicit in a tokenized world. You don't have to have a separate register. Which is where I would think that, the registrar, as we know today, I think they are more service provider to the company that is issuing securities rather than to the investor. So I think if at all they exist, they can exist as a participant on the same blockchain network. The CSD's registration function becomes implicit rather than explicit. Which means that if they govern that network, if they run that permission network, then they have an oversight, then they can do the regulatory reporting, they can get the list of shareholders, etc., as one central agent. But beyond that, I think there is no registration function. There's no really explicit need for a registration function. That will cause big, interesting. That's the disruption.
Go on. I'm wondering if there's an opportunity for them here as well, right? Doing it in a different form.
Yes, doing it in a different form. Sometimes, I say this very carefully, but the registrars are the weakest link in many ways in the whole transaction chain in today's markets, right? Because as technology advanced more and more, they are among the groups of people who could not always keep pace with the technology, because it's just such a you could say specific, maybe even low margin business in most of the countries, and they're not book builders, they're just issuers. So given that, I think the next stage of even efficiency would be for the CSDs to see this as an opportunity, provide that function, be the administrator or the organization running these permission networks. And if there is still a reason for the registrar to be the intermediary, they can actually run those. They can have a node on the blockchain. They can provide the service that's needed by the company if a company is not directly taking it. But otherwise, the registrar systems are not needed, and there is an opportunity here for CSDs. Clearly, you're right, Dom.
You touched on the question of interoperability, and a potential role for CSDs is to act as kind of switching stations for linking up security token networks, traditional exchanges, and so on. And we're starting to see technical standards like ERC20, ERC 1400 emerge. We're also seeing these computer protocols like FIN P2P emerging. These tokenized markets need old-fashioned, what I'd call, business messaging standards, the sort of Swift structured message types, or can they interoperate without business standards as opposed to technical standards and computer protocols?
Terrific question. I think the data standards are definitely needed, Dominic. Data standards are needed. Otherwise, you would not be able to exchange data and interpret it the same way, right? So I think standardized data models are needed. We are doing some very specific work on it, and even trying to see if 20022 and what we have inherited as 15022, 20022 can be a basis for financial data standards. Because otherwise, how do you interpret what you get, right? What you take from the distributed ledger, even if it doesn't come in a message. So I think data standards are necessary. Messaging will continue to be there, I guess, for a long time. It's been very difficult to move from 1502 to 2002 in my experience. Very few markets have moved. There are a lot of markets who are still on proprietary standards. They always support proprietary standards also, which means that a bulk of their customers don't change. As soon as you support that also and provide coexistence of standards, there are a group of people who will stick to what is the old standard because they don't see value in moving, particularly if they don't have international business. So when you put all this together, messages will remain, and the burden of interoperability will be there on all of us who provide systems. I think we need to be able to send messages back and forth, even in the tokenized world.
Well, as you point out, and the ISO report on ISO 20022 pointed out that an awful lot of custodian banks, for example, are very comfortable with ISO 15022. They see no case for moving to ISO 20022. But as one of more generally, you've got traditional, sometimes rudely referred to as legacy systems, which are operating on Swift and FIX and FPML. You as TCS banks would have had to build Swift engines into the platforms you provide to clients. Are those legacy systems or built around legacy messaging standards an obstacle to moving very quickly to security tokenization in the same way that they've been an obstacle to moving from 15022 to 20022?
Yes, legacy is an obstacle. You're spot on. Legacy is an obstacle. Also, not just because of the messaging, but also because of the way in which the modeling is done in the databases, the whole data structure. When you put it all together, and then there is multiplicity of systems, yes, it is an obstacle. So in fact, on our side, we are trying to create some form of transformation logic and middleware and gateways so that we can take that obstacle away. You take the message in its current form, and then you transform it into a more future state form, into a more, be it for the blockchain on a distributed ledger, or sometimes even for 2002. So you do a transformation in order to kind of interoperate, even though the legacy system from which you transform or to which you transform will not benefit from the true value of next generation data standards, because their data models will be old and legacy in any case, but they can work with the latest systems because you have a transformation in between. But yes, they are an impediment. But then that means replacement of lots and lots of core systems. So who's going to do that? Mm-hmm. That's where the challenge is. Very few people are replacing their core systems. Not enough CSDs are replacing, in my opinion. If you look around Europe, I think a lot of them are still on the older systems. Some of them are very standardized and they are already having 15022 and 20022. Some of them are not.
And do you find anybody's interested in, if you like, building a new system in parallel alongside, if you like, the existing system with a view to one day, transitioning clients onto it. Is that something which is not happening?
It is happening, Dominic. It is happening. I think they are building it in a small way. I think the examples that I took, the institutions that we are working with in terms of creating, you could say, next generation systems, next generation markets on distributed ledger. Out of the 4 or 5 that I spoke about, 5 of them, I think only one is doing it in the same solution with both. Everyone else is looking at something that will run in parallel, run for a separate market, get that approved by the regulator. Sometimes it's not even regulated yet. So they don't even have anyone to go to. If you're going to provide trading, probably ministry, but there's no market regulator for art or any of those, you could say, high net worth investment classes. So there's no regulator there. So you just need to be self-regulated. It is then a parallel market.
Vivek, we lost you a bit there, so let's just repeat that question. We'll edit this. So let me ask you it again. Do you see among the CSDs and custodian banks and others you're talking to, do you see any appetite for getting around the legacy problem by building a new system in parallel alongside the existing system with a view to transitioning clients onto the new platform at some point in the future? Is that happening?
Very much, Dominic. Yes. I think the majority are seeing it that way. Among the handful of institutions I spoke about, except one, all others are working with us to create a parallel infrastructure, right? Something for a different asset class than their current mainstream business, which is equities, fixed income, some cases commodities. So they are looking at something in parallel, a new market segment or a new board on which they will have a different set of asset classes which are tokenized, and that will run in parallel. They are trying to seek separate approvals for that where necessary. In some cases, it's not even in a regulated segment, so they don't know where to take the approval for because it's not a financial market in the current form. So that's how it is happening. So very much, there is a situation where parallel systems are being developed.
Now,
I would think we would have done this earlier, even for different asset classes, right? Equities to fixed income versus commodities, sometimes even different markets. And then, we started bringing those together into one system because the same CSD had 4 different systems. So now this is a new parallel system.
So they're starting with alternative asset classes, if you like, and then looking to move the orthodox equities and fixed income across to it at some point in the future. Yeah, makes sense.
Low volume, yeah.
And I want to talk a little bit about the custodian banks now, but before I do, I just want to come back to that point you raised earlier about central bank digital currencies. Are CBDCs going to be helpful to CSDs in responding to the security token threat come opportunity, or are they going to be unhelpful?
Helpful. Helpful, I would say, because CBDCs have a sovereign nature to it. I think they are a vehicle to the future for central banks. A fantastic opportunity to reach out to a new technology future without losing control over currencies, which I think pretty much every central bank wants. Right, so they can exercise control over the CBDCs. There is a security and a stability attached to it, which they can create. It will not go up and down by 11%, 14% in a day. But the wallet side is a challenge, right? I can see them creating it, issuing it. Will they directly issue it into wallets which are held by you and me? I don't know how they will do that, because today they are not equipped to service you and me, right? So therein lies the paradigm shift. I don't know if they will do that, or they will do that through intermediaries or subsidiaries that they will create. because that's a retail bank's function, right, for the last whatever hundreds of years.
Yeah. So could be an opportunity for CSDs if central bank digital currencies are issued into retail wallets, they start to run a retail banking business, but could equally be an opportunity for them even if the retail banks continue to intermediate that business. One is a kind of status quo option for them, and the other is perhaps opens up a whole new line of business to servicing retail clients. Is that what you were saying, Vivek?
Yeah, possible. Because see, that you don't need to run 10, 15, 20 of these blockchain networks in any country or region, right? I think there will only be so many of them. So the organizations that create them first will end up running them. That's my experience personally on the payment side. If you look at what has happened with digital payments in a lot of markets, the first movers have gained the majority or the first handful of players, and then they've grown on top of that. And then there are subsidiaries of central banks and financial institutions have been created to run real-time payments. So similar to that, I think you will have to have somebody overseeing and running it. It could be the CSD. It is an opportunity, yes. But if it's someone else's business and if they are only going to look at being the settlement organization for listed securities, then it will not happen, Dominic.
Right.
At the risk of being provocative, that's the factor, right? I think this is a very different business. Either they go out there and create it or embrace it and run it and be the one governing the permissions networks. If they say, no, this is not my business, or if their boards were to say it's not their business, then it will not happen. Someone else will do
it. Let's talk a bit now about the users of the CSDs, the custodian banks. We're starting to see certain of the global custodian banks develop crypto custody services, I suppose, cryptocurrency custody services. We're also starting to see some take stakes in digital asset custodians. We've seen BNY Mellon take a stake in Fireblocks and Standard Chartered in Metaco. Do you think that the custodian banks who are making these moves are really trying to teach themselves, to educate themselves about custodying security tokens, or are they simply responding to a kind of buy-side desire to have a custody service because they are investing in cryptocurrencies? Is this part education, or is it just simply responding to client need? What do you think is going on here?
Responding to client need. I think the education part is probably over for a lot of them. I think 3-4 years back that was more the state. I think they have the ability to move fast, in their organizations. Not all of them are creating the market or creating the business. I think they are more responding to the pull. Because if they don't respond, then these assets will be held under custodies by someone else, somewhere else, right? So it will not be a single custodian holding this. So I think they need to respond, so they are responding. I would put it that way.
Now, what about the technical side of doing this? We're talking about educating yourself. Clearly, custodying private keys is very different from custodying even dematerialized securities. And we've seen this evolve from the original sort of cold storage idea through these hardware security models where you plugged a dongle into your PC and then tried to have some sort of multi-sig process with others to mitigate the threat of assets being stolen. We're now moving towards multi-party computation. This is quite complex technical stuff. It's very unfamiliar to custodian banks. Do you think they have the right culture, right skill sets to keep up with this fairly rapidly evolving technical developments in private key custody? Are the custodians culturally and technically equipped to keep up, do you think?
Technically, yes. More technically than culturally, I would think, because that's how I would put it if I were to be honest. I think a lot of them are thinking that they will invest into some of the fintechs that are doing this work. I think the approach that's been taken by a lot of the big custodians is to say that one is that they will do some pilots. The second is that they will invest in some of the fintechs. And then maybe you could say buy the technology or take the technology from those of us who are providing solutions and then just be the person who's creating the business and implementing it. So technology is not the challenge. Technology is not the challenge because in one of 4 or 5 ways, either buying it from all of us who are providers or from the fintechs or being a stakeholder in the fintechs, they will get access to it. And that's why I said they can move very fast once they make the decision because they can have access to the technology. Um, they are not creating the market. That's the area where probably more innovation is needed.
Mhm.
Some of them, of course, are doing some work, like JPMC and others, but not to the on the whole. I think the big custodians have probably not done enough to create the market, right? Maybe they have not yet done that.
You touched on this issue earlier with CSDs about legacy systems being an obstacle to rapid change. But you don't just have legacy systems, you have legacy procedures, you have legacy processes and legacy standards, and lots of legacy lying around. How hard is it going to be for custodian banks to actually adapt their existing systems, processes, procedures? I'm not talking here about their culture, I'm just talking about the way they do things and the technology they use to do those things. How hard is that going to be to adapt those to security token markets?
Not straightforward. Not straightforward. It is going to be hard because this paradigm is very different. The paradigm is different, and the whole the end-to-end process itself will be completely different to what happens in the electronic or dematerialized world, right? I think you cannot just have the same process and then just store a token. I think that's if you can draw something on a whiteboard like that, but that's not how it will work. The underlying cryptography of the blockchain is different, and the business model has to be different and more efficient, right? Otherwise, what's the point, right?
Yeah.
It's not just about tokenizing in order to convert from an electronic form to a tokenized form. So I think the same systems will not always be easy to change. We are actually creating, you could say, crypto custody components in our solutions, Dominic. That's how we are designing it, right? The crypto custody, if I can call it that, the tokenized, custody is different from the electronic custody. You can see it in the same form. You can get one statement with both on it, but the underlying components are different. The process and the technology, the way which it uses the DLT is different. I think coexistence is better than to say the same system can be used. Because I think a lot of them cannot change their existing systems. We have to find ways to engineer a level of coexistence. But the crypto custody world is slightly different. And it's better to use those specialized systems and make these two run together.
And now you mentioned earlier that those clients that are looking to build a digital asset custody system in parallel with their traditional custody system are kind of focused on alternative assets at the moment. Now, it's become clear, I think, in the last year or so that the big opportunity here lies in privately managed assets, not just the real estate and the collectibles and the fine art where we're seeing things develop, but private equity and privately placed debt as well. I think McKinsey put a figure on that market into last year of $7.5 trillion. So it's actually a big market opportunity, even relative to the publicly traded markets. Now, obviously, the privately managed assets are not a market which custodian banks are, a major force in at the moment. How do you think they can set themselves up to start to exploit that opportunity? They're doing a bit of private equity administration and so on at the moment, but how would you advise a client to tackle this massive $7.5 trillion privately managed assets opportunity?
That's a tough one because it's just not their space today. Actually, But I think they need to partner with, directly with the stakeholders in these spaces, with the private banks, where they have to work with the private banks. The private placement is not in their space right now. And also, if you were to look at private equity, and let's say you imagine a world of private equity or private placement on a DLT, Dominic, right? There's really no need to go the custodian path there, right? I think you can have the end-to-end value chain without the current custody process. So for the custodian, I think they need to create this as a separate business and run this as a separate business. It cannot be the custody business that will somehow become the back end of a next generation DLT based private equity solution. I would not envisage it like that. So I think the private placement can be directly handled. If the custodians, I think some of the custodians are seeing this as a space for them. They are talking to us. They want to participate in this. We are on the whiteboard on some solutions with them. But then, like you said, they are not the major player. So they have to partner with the players. But the private banks, right? If you look at it as a private banking space, the large private banks, I think there is a very good possibility there, because they provide end-to-end in those countries, like Switzerland, right? They provide the complete service from trading to custody. So for the private banks to have a play in private equity and then have a play in private equity in a crypto form, I think they are in those handful of markets where where everything is run by them. I think there is an opportunity for them.
And I guess the private banks have the type of clients which are willing to pioneer investment in security tokens as well.
Absolutely, yes.
Now, one advantage that the global custodians do have is that, and this is a kind of paradox of the whole blockchain security token thing, is that the institutional investors want to continue to work with custodian banks. They like the credit intermediation. They like the idea somebody will make them whole if their assets get lost or go missing. And that's as true of a prime brokerage relationship as it is of a probably especially true of a prime brokerage relationship as it is of a global custody relationship. But on the other hand, this security tokenization thing is all about cutting costs and being more efficient, precisely by eliminating intermediaries. How do you think this is going to play out? Do you think that cutting costs by getting rid of intermediaries is going to be the story, or are these intermediaries going to stay in place because actually they do something which is very valuable to institutional investors? Which of those arguments is going to prevail in the long run, do you think?
The latter, valuable and efficient. I think the biggest change that will come is in terms of efficiency. How close to real-time, instantaneous settlement can we get to, right? I think, if we can give the value of time, then a certain higher cost is something that most investors would give for the value of time, right? So measured against time and the efficiency that will bring, I think the cost will be okay. Economy of scale will drive the cost down, like it has done in security settlement. It still has some more potential to go down. So I would think that would be more the case rather than the intermediaries completely not being there. I would not see it that way. It's difficult to take a banking or payments paradigm for this. This is very, very different, particularly because of so many different types of asset classes that we can all hold, right, as part of our investment portfolio. But private placement and private equity, it's a good thought. The way you put it, Dominic, it's a very interesting thing you have posed. Something on which I will do some more spade work. I think that can really take off. And just during the course of this conversation, it has made me think how much that can take off. And like you said, it's trillions, right? It's not like some small number.
Yeah. Now, there's another paradox here, which is that people say great thing about blockchain is that you have this atomic settlement, a kind of real-time gross settlement. Problem with it is, of course, you have to pre-fund accounts with cash or securities. And then people remember that actually netting is quite valuable, particularly in terms of savings in capital and liquidity. An institution like CLS, almost the whole of its benefits is delivered through netting. That's the value which central counterparties deliver as well. Do we think that the security token markets can actually deliver the benefits of netting, but also the benefits of atomic, instantaneous, real-time settlement, or are those two things contradictory?
At this stage, I would think it's contradictory, right? One runs counter to the other, which is also why I said that a lot of these parallel systems that we are working on, that we are creating, are high value but low volume.
Mm-hmm.
The netting effect is very marginal in those transaction volumes, and with the kind of players which are there. So when you are having less volume, high value, and the need for instant settlement, I think a tokenized DLT-based settlement lends itself so much better to that, and I think that has its value. And netting has its own value, and it offsets, and the kind of liquidity that gets released because of netting is phenomenal. So I think in a way they run counter to each other. So that's also the reasons why some people may say, let me hold on to where I am, isn't it?
Mm-hmm.
Right. There's no reason to not, a combination of the power of netting and the kind of capital that is needed in order to provide the guarantees that you spoke about, Dominic. Right. I think if you need to give that comfort to the investment community, then you need the capital adequacy and the big balance sheets that the banks bring into the business, isn't it, in order to be sure that what you're doing is safe.
Mm-hmm.
So how do you take out the intermediary who brings in the strength of that capital? You cannot take them out because the risk is underwritten by them. So that's where I still see some of this running in parallel.
Which helps to solve a sort of third paradox, which has occurred to me, which is about central counterparties. A lot of that netting, obviously, as I said, was done through them. They act as the counterparties to every trade. And guess what? I was reading a very futuristic paper about a blockchain future in which every consumer owns their own data, and they decide who can see what, and they use that data to do their KYC, AML, sanction screening, CFT checks. They use it also to buy goods and services on this interlocking set of blockchain networks for all types of goods and services. But I also noticed they said that a central counterparty clearinghouse would be a very good idea to put into a model like that, because it could act as the anonymous counterparty to all the trades and start to reduce that counterparty risk. So I sense for the first time that people are thinking that maybe CCPs actually do have a future inside a tokenized economy. Do you think that's true? Do you think CCPs have a role to play in security token markets?
Yes, because the risk management needs to happen, and that is where I think they will come into play. That's why I said, wherever there is a time factor, right? If it is not instant settlement, then who is the party in the middle? You need someone in the middle, right? Who is managing that risk for whatever be the period of exposure, be it tokenized or not tokenized. So I would say that where you have settlement that is instantaneous, then you can do that without the central counterparty. So it's like pretty much gross settlement instantaneous. But if it's not instantaneous, then someone's got to do the netting. And if someone does the netting, then they will have to manage the risk. So, and for that period of time. What that period of time, maybe the future will determine. Netting brings a lot of efficiencies, so we cannot completely do away with it. I would still see markets as T+1 going into the future, not instantaneous. So there would be two different types of settlement for the medium term, at least, Dominic.
So it'll be a messy system with a bit of atomic settlement, but also options to net and to use central counterparties as well in the medium term. It will be a transitional period. We may end up with one or the other, but not immediately.
Yes. Even our marketplaces today, which are there, not necessarily for securities, but for other forms of transactions that we do, in some form they've become central parties. I don't want to call them CCPs for obvious reasons, but they all play a central role, isn't it? The Amazons of the world also play that. The wallet providers of the world play that. They take from somebody, hold it while they manage it. So, of course, in small quantities, I think most nations are managing this risk by limiting how much you can hold with them. But beyond that, I think it's still risky. So I think the risk needs to be managed, at least for institutions, and only CCPs can do that today. Only they are there in a position to do that today.
One last question for you, Vivek, because we must let you go. And it's this: the cryptocurrency markets have given rise to this decentralized finance or DeFi market, in which all sorts of very interesting experiments are taking place. Do you think that is a market which custodians and this probably applies to CSDs as well? Do you think it's a market which custodians and CSDs should be looking to understand, to see if there are experiments or new technology or new techniques being pioneered there, which might be useful to them as they make their own transition to security token markets, or indeed which they could apply to their traditional business? Is DeFi a market which custodians and CSDs should be looking at for ideas about doing things differently?
Absolutely. I think a great point to kind of round up the conversation, Dominic. I would think so, and I think if you were to look at how you apply the principles of DeFi to lending, right? What is the way in which they can unlock, what they hold today? How do they provide more efficient services to the people to whom they are holding assets under custody? I think the opportunity is huge. So I think they should study it carefully, and I myself would like to see them doing some of these projects in the next couple of years, rather than to see that I think a lot of time too many people are are waiting for this or that, a handful of let's say 2 or 3 projects which are happening somewhere in the world, and say let that progress and then we will see. But I think they don't have to. Yeah. It's a great opportunity, actually, and also to create the next generation financial services systems.
Vivek, thank you very much.
Thank you, Dominic. Pleasure talking to you today, and it's been absolute pleasure to exchange these ideas, a lot of which I think we can build on as we go into the future. So great to talk to you.